Hi everyone, this is Ashish Shankar, Head Investments at Motilal Oswal Wealth Management. I welcome you to the second season of Know Your 4C Fund Manager. This is the second episode, and we'll be exploring today the world of fixed income. The fixed income markets have been extremely volatile, and we've seen a few accidents in the credit space. To talk us through all of that and more, I have with me somebody who's been investing in fixed income markets now for close to 2 decades. He's a practitioner, an expert. He's a pass out from the prestigious IIM Calcutta, has worked for institutions like Deutsche Bank, HSBC, and he's been heading fixed income for IDFC Asset Management now for close to a decade. In fact, he has been quite vocal about avoiding the credit space over the last couple of years and has managed to sidestep or navigate this minefield of credit extremely well without a single accident. So I welcome to this show Suyash Choudhary, Head Fixed Income, IDFC Asset Management. Suyash, welcome to this show.
Thank you so much, Ashish. Thank you for inviting me today.
Yeah. So before I go into your specific philosophy and strategy on fixed income, I know that you have a pretty robust framework around macroeconomics and interest rates. So there's lots happening in the world of macroeconomics globally. A lot of liquidity being pumped in by central banks as well as governments. So please talk us through your framework, what you're seeing, and how you view things evolving going forward. And obviously, subsequently, we'll come to the impact on India.
Sure. So as things stand right now, there is obviously a bit of optimism as we reopen. It's clearly reflected in asset markets as well. The optimism, as far as we see, is around three areas or three supporting factors. One is clearly the fact of reopening, where industry services, etc., start to come back, capacity utilizations begin improving, and that's something people look forward to. The second is there have been some bit of positive data surprises over the last one and a half months. So compared to the range of forecasts, some of key data points have been slightly better. And third, but most importantly, is if you see the size of the backstops and policy support that has been provided by central banks and governments, especially in developed markets like US and Europe, they form a very substantial portion of these individual blocks' GDPs. And if you especially take the case of the US, the size of the deficit is now truly mind-boggling. We are talking about 10 to 12% of GDP extra, over and above which the US Fed itself has unleashed substantial expansion to balance sheets as well as direct lending to the corporate sector. Now, whichever form this dip and subsequent recovery takes, so what needs to be highlighted is recently most forecasters have turned slightly more pessimistic because the lockdowns have sustained for longer. But if the size of the stimulus were to keep on increasing, probably that could be partly mitigated. But whichever format this takes for the next 1.5 years, which is when the dip turns into some bit of payback of growth, what one also has to look forward to is how long or what the future holds once we are through this phase. And unfortunately, some of developments there will have some ramifications or residues as far as the future growth potential of the world is concerned. The first is most of the spending necessarily has been around survival, because this is a survival shock to the world. Right. And survival spending is around employment guarantees, income guarantees, cash transfers, small and medium enterprises being capital, etc. And this is welcome and necessary. So obviously one is not criticizing the kind of spending that has happened. That's exactly what was needed to be done around the world. However, the multiplier or the growth multiplier effect of this kind of spending is relatively weak. So imagine a government spends money in building infrastructure. There are very powerful and durable forward and backward linkages to that, which sustain over a period of time. Whereas one can argue that a large part of the current spending, although completely necessary, will have low forward growth multiplier impacts. And therefore, although debt to GDPs will rise, the trajectory of GDP may not necessarily rise for much longer. The other aspect, which is also, or which is quite alarming, is that there has been a trend of deglobalization underway for a few years, especially after the global financial crisis. So it's clearly reflected in world trade growth being more muted, and most major geographies around the world, including India, the growth in these economies is very strongly correlated to world trade growth. Now, the trend of deglobalization has been upon us for a few years, recently accelerated by, let's say, the US-China trade dispute. What we fear is that in the COVID and post-COVID world, this trend of deglobalization further gets legs. So there'll be more cross-country suspicions, more revocations of supply chains, and on aggregate for world growth, it's not that good. The third factor, one thinks about is even when we fully open up, until we get a vaccine or immunization, the full opening up will not be anywhere close to the previous full opening up. So there'll still be industries and services which won't be able to go back to full employment. And this is something that one has to acknowledge. And the fourth, which is truer for countries like India, is there has at least been a temporary dislocation to factors of production. So for instance, there's been quite a bit of reverse migration of labor. So labor probably in the near term is sitting in places where there is not enough employment opportunities, whereas where there is a requirement, there is necessarily shortages right now. Now this is, although an important point, it's a temporary point, it will get corrected. But these are some factors, some of which temporary and some of which permanent, which don't argue for a very robust framework of growth for the world once this U, V, or W shape is beyond us.
Right. So just to summarize, Suyash, you're basically saying there are four factors which are going to weigh on growth. One is the inflated debt to GDP ratios for most countries, especially the developed part of the world. Second, deglobalization is a theme that has been continuing since 2008. It'll only accelerate going forward. Third, till we find a vaccine or a cure for this pandemic, demand is likely to be slack. And fourth, more importantly for India, a lot of the factors of production have got dislocated, and that'll take a while for supply chains to recover. So you're saying that it'll weigh on growth going forward. So what kind of bearing will it have on interest rates globally, and subsequently, how do you look at the interest rate framework in India?
So clearly for the world as well as for India, we are looking at a very different level and trajectory of public debt to GDP. Although in India, as is well documented, the actual cash outgo of the stimulus so far is roughly around 1% of GDP. It is much higher for many other countries, specifically in the developed world. In the developing world, it's higher, but not so much more higher. But given, let's say the starting point of fiscal, especially I'm talking in the Indian context, or public deficit more broadly, there are going to be shocks on revenue side, as well as there'll be need to continue to spend more. And therefore, the trajectory of public debt to GDP will look quite different. And this will also be true in some form or fashion in many other nations around the world. Now, as far as developed markets are concerned, it's relatively easy to continue to finance a higher level of public deficit because they essentially are the printers of what are called the reserve currencies of the world. Right. So the US Fed prints the US dollars, and for the foreseeable future, it's unlikely that people lose faith in the US dollar as a store of value, as a reserve currency of the world. And therefore, at least for the foreseeable future, it's reasonably easy for the US Fed to continue to finance the government debt. In an emerging market context, this is not so easy because we essentially are not printing reserve currencies of the world. And in an emerging market context, there are two essential preconditions for running this kind of a large public deficit. One is that most of it should be domestically financed. And second is that for that emerging market, the external account should be relatively stable and concrete. Fortunately for us, we are meeting both these conditions. So for our debt is largely domestically financed, and that is going to be true for a longer period of time. Our external account is bulletproof right now because our current account deficit has collapsed and we are getting tons of FDI flows. And therefore, you're seeing what's happening to our forex reserves. It's now exceeded the $500 billion mark and only on the way up. So therefore, in the near term, India meets these conditions, and we don't expect too much of instability arising from just the high level of public deficit. What it does mean, and it means globally, is that, especially in the developed market context, is that you are in for some sort of what you may de facto called a financial repression for a longish period of time. So the way a monetary policy, let's say for a developed market would work is that if interest rates were to start to inch up due to the weight of this oversupply of bonds, let's say a Fed would have to intervene because this could amount to de facto tightening in financial conditions, whereas they're still trying to get employment and jobs back. And therefore, they'll keep pushing against that rise in yields by doing more asset purchases, etc., either direct or
Hence,
indirect.
Fed will have to increase the size of its balance sheet.
Absolutely. So you are in for a longish period where, in some form or fashion, there is fiscal dominance to monetary policy. One cannot rule out that in India as well, there may be some sort of actual or practiced dilutions to the inflation targeting framework. It could be slight. So this fascination with the 4% mark may get diluted to some extent, because simply when you're running this kind of debt and the economy is now operating at a lower level of potential, probably some bit of financial repression is to be expected around the world.
Right. So what you're arguing for, Suyash, in effect is lower for longer, at least in the global context. And wherever this supply of bonds will be an overhang, you do believe that central banks will act aggressively by increasing the size of their balance sheet. Of course, for India, you did mention that the external account is very, very strong, and our reserves have hit close to $500 billion. Now, one concern always in India is with the debt to GDP ratio increasing even in India, albeit not so worryingly like probably the developed part of the world, and with revenues falling sharply for the government, because we are seeing a tepid recovery, and you did mention that growth will be challenging going forward. So with pressure on government revenues, increased borrowings, what does that do to interest rates in India? Because government is the biggest borrower in India, and that has a bearing on interest rates that corporates have to pay, or eventually individuals also have to pay.
So if you were to look at India slightly more broadly, unfortunately, we have entered this crisis already in a weak position. If you were to just examine some aspects of it, so one, growth in India has been slowing now for a number of years. So from 8 to 7 to 6 to what would have been 5 for FY20, but with the post-COVID shock, the official print is around 4.2 for the full year. FY21 is anyone's guess. Most forecasters are around -5%. But India has been slowing for some time. And you could argue our potential growth rate itself has been slowing as well, which in turn probably is linked to a significant fall in our investment to GDP ratios over the last 4 or 5 years. With this slowdown, there are two vulnerabilities that India has had to combat. One is a somewhat severely compromised lending system. I'm talking in aggregate. Obviously, there are strong entities within that system who would dispute this generalization. But on aggregate, the banking system has been running close to 9.5% NPAs. Post the ILFS crisis, there have been quite a few NBFCs and housing finance companies in the system who have just not gotten balance sheet level financing at any sort of competitive levels. And therefore, the financial system generally has been under stress. The other aspect is, if you see, public deficit already has been quite bloated for the last 4 or 5 years, which in turn probably is linked to a slowdown, which impacted revenue growth rates, as well probably that the GST reform did not yet translate into tax buoyancy as may have been envisaged. So India entered this with a weak growth profile, with a compromised or stressed, not compromised, that's too severe a word, a stressed lending system, and the ability of public deficit to expand being slightly constrained. And therefore, it wasn't the best picture as we entered this. Now, what are the tools we have that we can optimally use? One is, like I said, because of the growth collapse, our current account has collapsed. And therefore, on an external account, we are looking quite good. right? So that's one very large defense we have in place, which is exactly the mirror opposite of what happened to us in 2013.
Right.
The other is, if you look at what public policy can do ahead, uh, it has to work within constraints that it doesn't have too much extra money to spend. At the same time, it has from here on to maximize the growth multiplier effect of its spending. So now that survival spending is largely done, incremental public spending has to focus on ensuring that it's largely towards public investment and maximizing growth multipliers. It has to divest aggressively so that although the fiscal deficit starts to consolidate, the fiscal impulse, which is essentially, your spending minus taxation in some sense, does not get compromised too much. And it has to provide huge amounts of policy stability for us to be able to draw back some bit of trade in what is an overall shrinking pie. What it means for interest rates is, uh, generally speaking, the difference between the so-called haves and have-nots, which is companies that you perceive to be safe, and the companies where either for corporate governance or balance sheet issues you don't perceive to be safe, that wedge in financing cost will continue to widen for the foreseeable future because the system is very unstable. The second thing is, from an RBI standpoint, and we think RBI so far has done a very good job of managing this situation. So there is plenty of excess liquidity. The system is operating at the reverse repo rate. There is very clear forward guidance about interest rates. So the forward guidance is they're still looking for rate cuts, not for rate hikes at all. And there does seem to be an invisible hand of the RBI in the market because despite the massive amount of government borrowing, yields are largely stable. We think the game the RBI is playing is a slightly longer one because there's a very large amount of borrowing that they need to push through. And therefore, we have termed their operation as a passive put rather than an active put to the market, which basically simply means is that they're not trying to engineer yields to go lower, but they will intervene if yields go higher, with an objective being that at a steady state basis, you push through this borrowing. So from an interest rate standpoint, obviously the best quality because of the extraordinary amount of uncertainty in the lending system. So focus only on the best quality and chiefly at the front end of the curve, because curves will continue to be steeper because of the very large supply that lies ahead of us. A medium-term challenge is going to be debt sustainability for India, because like I said, in an emerging market framework, that slightly becomes challenging, and therefore we need to get growth back in the next 2-3 years. Understand that it's not a given, right? And like I argued for before, probably a potential growth itself is getting somewhat on a weaker trajectory, and therefore there's a very large role for public policy ahead, not necessarily in terms of intensity of fiscal spending.
Right. Interesting. So what you're arguing for, Suyash, in India's context is there is no choice but to grow out of this crisis. And a lot will depend on public policy. So as to, let's say, liberalize factors of production, make things easier for businesses to function, and invest in infrastructure, because that has been something that has been neglected, as you mentioned. Now, given this framework or given this situation, what you're saying is interest rates will remain low, but you do not see too much room for interest rates to go down from here. Did I hear that right?
So the way we look at interest rates now is just purely almost from an opportunity loss or benefit standpoint. So what do I mean by that? Let's say a 5-year government bond is around 5.25, right? Overnight rate is effectively at around 3.25.
Correct.
Nothing happens to interest rates. You are basically making 200 basis points by holding that 5-year government bond over the overnight rate per year, right? Which is a full 2 rupees. And this analysis you can extend to any mutual fund product that you're buying as well, which is basically, for instance, what is the carry advantage of holding a short-term fund over a liquid fund, right? And for the same credit quality. So obviously we are talking about like to like, apples to apples, a AAA liquid fund to a AAA short-term fund. So what I mean is that even at the front end, there is enough steepness to the yield curve. So your 1-year T-bill is at 3.5, your 5-year government bond is at 5.25, right? So there's enough steepness, which gives you almost passive levels of carry incomes and protects you from any future hikes in interest rates or other increases in rates. And those increases may happen without RBI aggressively hiking rates at all, because the increases may happen because RBI stops supporting the borrowing program to the extent it's supporting this year. So to clarify, yes, we think it's a stable interest rate environment. The biggest values are at the front end of the yield curve. Don't look for mark to market gains. Even the opportunity benefit of holding on is very high because the overnight rate is too low. From a monetary policy standpoint, low policy rates are there for longer because it will take time for the growth drawdown to come back. But the long end of the curve at some juncture, unless debt to GDP matrices at least start moving in the right direction, will probably start to feel the pressure of the higher borrowing program of the government of India. And again, to reiterate, for an emerging market, unlimited debt monetization cannot be the solution. You can do it for 1 year because that could be the policy prescription in an very, very extraordinary environment, but it can't be sustained for 2, 3, 4 years. And a final point, although India needs to grow out of it, like I said before, it's not a given. So you need almost a break in public policy. You need, a reset in favor of maximizing multipliers of spending, optimizing the fiscal impulse of spending, and laying out policy certainty, absent which 1 or 2 years down the line, India's macros may not look too good at all.
Right. So in essence, what you're saying is that at a policy rate level, we could be lower for longer. RBI will keep policy rates lower. Hence, the difference between where the policy rate is and let's say 3 to 5 year bonds, the difference is still quite attractive.
Absolutely.
However, you're suggesting or advising people to stay away from the long end of the curve, which is typically duration funds, 10, 12, 15 year kind of maturities, because the supply side could be overhang. Government borrowing could be overhang. And hence the 3 to 5 year or 2 to 5 year, the curve is extremely steep, which is basically the difference between the short end rates as well as medium term rates. So I guess from an expectation perspective, I would think that investors need to get realigned to lower rates. However, within this yield environment, the 3 to 5 year space is still very, very attractive because a lot of people don't get reconciled to absolute rates. People have seen 7-8% sometime back, and now most of the funds are the good quality funds are at 6%.
Absolutely. So if I may just reaffirm some of the points that you made. See, absolute level of yields are immaterial because 1 year back we were growing at 5%. Now we are growing at -5%. This kind of a growth shock the world hasn't seen since the 1940s. And therefore, we are living outside of any experience that any of us has ever had in the marketplace. Right. Therefore, everything is relative. Now, from a behavioral standpoint, one of the greatest things to understand is to not overreach on risk profile in order to try and beat an arbitrary threshold that you have set for yourself. So, many times we have seen at 6% people say, oh, 7 is what I wanted. At 5 people say 6 is what I wanted. So that's why I call these arbitrary. Right. We again starting to see a reach for yield. Right. And that's the first, danger sign that we are beginning to see in the market. And if we talk, during this conversation, I'm sure we'll discuss asset allocation as well. Yes. Yes. There is a place that high yield or active duration sits in your asset allocation. And for the most part, it does not. And, from a psychological standpoint, I would think the next 1.5 years are about not making mistakes. They are not necessarily about maximizing return, because we are truly in a once in a lifetime unprecedented environment where we entered with a relatively weak macro and a stressed banking or credit system.
Right. So just wanted to reiterate that point again, Suyash, that last 1 year, a lot of these high quality funds have in fact seen double digit returns, 10%, 11%. So I just wanted to caution all the people watching that please temper down your expectations. These returns cannot be repeated. Today, the yields for good quality funds in the 3 to 5 year space are between 6 and 6.25. And that's the kind of expectations we'll have to live with. But like Suyash explained very beautifully, that it's a relative world. So in a world where you're looking at a shrinking GDP and much lower inflation rates, 6% is good, and don't try to chase absolute returns because the world is largely relative. So, Suyash, thanks a lot. I think that was a fantastic macroeconomic, overview on how to look at interest rates. I would now like to move on to your style of managing money. How you build portfolios at IDFC. I mean, you're responsible for close to 80,000 crores of fixed income assets. And I know that you've been extremely wary about credit over the last few years. And in fact, you also believe that open-ended funds are probably not the format to do the kind of structuring that some of the fund houses have been doing. So I just want to understand, what is the overarching philosophy at IDFC when it comes to managing income money?
So if you think about this from a long cycle standpoint, what are mutual fund products? Fixed income open-ended mutual fund products are pass-through vehicles where you put your money, I invest the money, you ask for your money back, I sell what I have bought, and I return your money. I don't think one can challenge the construct as I defined it, because that's exactly what we are. The premise here is that my liquidity comes from the market I'm invested in, not necessarily the profile of my customers, right? So my liquidity, to repeat, comes from what I have bought and I'm holding in my portfolio, not necessarily whether I have retail or wholesale investors, because as this cycle has shown, you can lose large chunks of money even if you have a retail investor profile. Now, if one were to apply this structure of a mutual fund to the place we are in the evolution of our financial market and the risk profile and expectation of the customer that we are servicing. So essentially we are taking customer money and investing them in the market. So we are basically dependent upon these two. So we are dependent upon the market to provide us liquidity, and we are trying to cater to an investor whose risk philosophy, whose expectation we need to clearly understand. And you have to apply this framework in the stage of the life cycle of financial market development we are in. So in India, within fixed income, government bonds are very liquid. AAA corporate bond is liquid enough. So it may not deal too much secondary market volume, but we have found over a period of time, most investors are passive, and at a price, they will buy almost any amount that you want to sell in normal markets, right? Lower rated credit in India never found liquidity so far. So it's not anything. So COVID may have accentuated this, but even 2 years, 3 years back, lower rated credit, especially A and below, had next to zero liquidity for the majority of such credits in the market. We have actually done an analysis in 2018 around this. So till date, we were not comfortable that the market that we are investing in will necessarily be able to provide us liquidity. It may happen down the line, and in which case our thinking may change with respect to credit, but to date that has not happened. And that probably coincides with where we are in the development of our market cycle. Then look at the investor. Till very recently, even the largest corporates in India were almost predominantly fixed deposit investors. I'm talking about 7-8 years back, right? So in India, both retail and wholesale largely comes from a fixed deposit mindset. Even today, if you see the proportion of mutual fund to fixed deposit, mutual funds are a speck almost compared to fixed deposit. So the mindset of the consumer also is that necessarily they are consuming fixed income almost in a fixed deposit risk profile. But from time to time, we have shown them a false trade-off. So we have shown them that, you can earn 11, which is almost risk-free, which is like almost irresponsible, right? Because if a fixed deposit gives you 6 or 7% and somebody is offering you 11, there is risk associated with that. So we basically, showed a false risk trade-off to the investor. Probably, the risk profile got compromised. So if I were to tie both legs to our platform, the market we operate in provides liquidity only for government bonds and AAA. And therefore, by definition, in an open-ended mutual fund, for the most part, my book has to run that. And my products have to reflect what the investor needs, which is, a slow gravitation away from fixed deposits. And therefore, for the largest part, products that are closest to a fixed deposit risk profile, while acknowledging that a mutual fund can never guarantee returns.
Yeah, well put, Suyash. I think the three takeaways from me are that you look at liquidity first, because you do believe that these are pass-through vehicles. And whenever the investors need their money back, the portfolio should be easily liquidable. And like you rightly mentioned, that government bonds are extremely liquid, and certain high quality corporate bonds also, the liquidity ain't bad. And second, like you rightly said, a large part of the Indian investors are still migrating from fixed deposits. So they look at fixed income as a safer avenue to park money and get some yield on it. So obviously your portfolios reflect that. And lastly, but not the least, I think the mandate is very, very clear that people need safety of capital, liquidity, and certain returns. So most of your funds are managed accordingly. I just wanted to also, again summarize to our viewers that in fixed income, really all the funds are mandate based. So you have liquid funds where somebody can park 1 day money, 3 day money. These are extremely liquid. They're invested in markets called CPLO, where you're basically investing in government backed securities. You have ultra short term funds where you have some corporate bonds where you go up the maturity. And then you have bond funds that too, within that you have banking and PSU funds where the mandate is very clear in terms of what kind of issuers, and the mandate of the fund is clearly stated upfront, whether it's going to invest in 3 to 5 year maturity papers. And then you have gilt funds which can invest in longer. So there are broadly, if I leave liquidity out and reinvestment risk, there are broadly two types of risks. One is a credit risk, which is basically you're trying to make a slightly higher return by investing in a issuer which is lower rated, maybe AA or a single A, and you're making money through getting your interest rate call right. By if you believe interest rates will go down, you can invest in higher maturity papers. Now let's come to the world of credit funds, Suyash. And like I said upfront in the beginning, I think you've been very, very vocal about the credit space and have managed to sidestep all the accidents that have happened in the credit space. You do run credit funds as well. So what is your framework to look at credit in those funds?
So I would, start with the overall framework we operate with on fixed income. And
right.
We are very particular in executing that framework. In fact, it's something which is very, very close to me. And, our entire platform in some sense has reflected that. The philosophy has held us well. And the philosophy essentially is, coming off, what I said before. So we split the investment book of fixed income. So there's liquidity book, which is largely cash and overnight funds. The investment book into core and satellite. Now core fixed income, and this maps to what should, in our view, be the asset allocation table for an investor in fixed income. At probably 70 to 80% should be core fixed income, and maybe 20-30%, or if the investor is risk averse, even zero could be the satellite bucket. Now the core bucket is defined by two parameters. It should be low on credit risk and it should be low on duration risk. Because by definition, these are the two large risks that we take when we deviate from a fixed deposit risk profile, right? So the core bucket is meant, while acknowledging that a mutual fund cannot guarantee returns, the core bucket is meant to provide a risk profile for various investment horizons, which can be as close to a fixed deposits risk profile. To be low on duration and low on credit risk, and this is self-imposed, right? So here we do products which run from money market funds to a short-term or a medium-term fund, which can have an average maturity not exceeding 4 or 5 years. So in our portfolio of products, we would put a low duration, ultra short money market, short-term, medium-term, a corporate bond, banking PSU kind of funds here. Importantly, the names mean nothing. They cannot be extrapolated from fund house to fund house. The characteristic of these products is they are low on duration and low on credit risk. So for instance, if you have a minimum 3-year investment horizon, you can choose a corporate bond fund or a medium term fund, which are part of the core bucket, but they cater to a longer investment horizon, just like you have longer term fixed deposits in the market as well. If you have a shorter horizon, you can come to a money market fund. Then we have a satellite bucket of products where we take credit or duration risk. So that is where we plug our credit risk fund, our dynamic bond fund, which is a interest rate risk product, our government bond funds, which are interest rate risk products, and our mid to long funds, which is again an interest rate fund product. So in some sense, we are treating credit and interest rate risk fungibly. So we are saying that when you take higher amounts of those risks, those products are satellite bucket products. where you cannot put more than 10-20% of your allocation, and 80% has to come into core, which is low on both credit and duration risk, right? So that's really the framework that we have applied to building of the platform. And in fact, we designate which of our products are core bucket products.
Right.
So the
That's a
principle
very,
behind,
yeah. Go ahead.
the principle behind managing the core products is, you have to bat with a very straight bat. It's a very well-defined framework for each of the products that we manage there. Now, when we did a credit product, and that's the question you had asked. So why did we finally enter that domain, right? So there were one or two parameters that determined that. One is we found there is a set of mid-yield credits, which are not, very high yield, which are not, done bilaterally for the most part. They are largely mid-yield, which are transacted through the secondary market, which are in the AA minus space, which we could potentially buy while adhering to an overall philosophy that it's really the market that provides liquidity, not the nature of the client that is investing in your fund. And second, that book in proportion to what you can handle has to be very small. So that book has to grow over a period of time. You can't be impatient with that book. So for instance, today, out of the 85,000 crores in fixed income we run, the credit fund is 800 crores, right? So it's not that we have consciously put it at 800 crores, but we never went out and said, no, this is the fund to buy for everything that you're buying. We said, first apply the core satellite principle. And within that, if you like it, you buy it. Importantly, for the last few months, probably more than a year, our commentary has been that the macro narrative is not suited for buying credit funds, including ourselves, our own, because I can't justify the credit fund from a macro narrative standpoint, even though I may have relative confidences in what the product is holding, right? So there's an investment rationale, and the other is whether the product will weather it. And we did not find an investment rationale, and we said it's not a point to be buying credit risk fund. So this is the overall philosophy we always follow. And this, perpetual battle between interest rate and or duration versus credit actually belongs to just that teeny tiny 10-20% of your overall allocation. But if you see the amount of time it consumes in public media, etc., over time you have found, are duration funds better or credit risk funds better? Is it time to come to credit risk funds again, etc.? We spend way too much time discussing what should be not more than 20% of your fixed income allocation.
Sure. No, that's a fantastic way to look at things. And I just want to reiterate that framework. I think it's also a very nice risk management framework. So like Suyash said, if you're building a fixed income portfolio, 70-80% or what he calls core of your portfolio should be in simple roll down kind of products or accrual kind of products, where you buy simple funds like corporate bond funds or banking and PSU funds, which have 2 to 5 year maturity, where there is no credit risk. These are all high quality corporate bonds or bonds, and you're just collecting yield on these funds. The tactical part can be maybe 20% or so, can be in some credit funds, as well as duration funds where the fund manager is taking an interest rate view. Even on credit, I think you made an important point again, Suyash, that you typically buy papers of issuers which are in the AA minus space. But more importantly, you don't depend on bilateral transactions for liquidity. A lot of them are also traded in the market, so that tomorrow, if you're hit with some redemptions, you're able to easily liquidate them. And I just like to give the same analogy to a diet, right? When you're going to a restaurant and you're eating, is the main, if you overeat the dessert, you obviously have acidity tomorrow. And in a lot of cases, portfolios, what I see is that people have over allocated in the dessert portion of their diet, and that has really caused massive amounts of acidity, which should have been 15-20%, so that it didn't occupy this kind of a space, in public platforms and discussions. So that's a great way of looking at things, Suyash.
I would just make one additional point, Ashish, if I may. So sometimes it's not as black and white, because there is a continuous dilution that can happen in portfolios. So right, because our system generally has been very obsessed with yield to maturities, you may run a banking PSU fund which you load up on additional tier 1 bonds. You right, can low duration fund which starts loading up into AA paper. And then right, you start to say that, oh, these are 80-20, 70-30, etc. Our sense is these diluted portfolios belong in the satellite category, because they are not 100% fail safe anymore. And the whole point behind the core bucket is that when your chips are down, when you are in the fear part of a financial market cycle that invariably will come every 7, 10, 12 years, as we are in one. This is your nest egg, this is your go-to, this is the amount that will always be safe. And if you look at your entire allocation across equities and private equities and real estate and high yield credit, you need this part. And therefore, we don't have anything against diluted portfolios, and which is why I said earlier the generic product name means nothing. But by all means, do diluted portfolios, but do to the extent you would do satellite bucket. With the core bucket, one has to maintain a certain level of discipline because this is your go-to nest egg.
Suyash, another category which is relatively small compared to the size of the industry, but it is gaining popularity, is arbitrage funds. I mean, we've seen that broadly, on a month-to-month, you find volatility, but on a 6-month rolling period, the returns have been reasonably stable. How do you view that category of funds? I mean, you also do run a large arbitrage fund.
So I can tell you as a consumer, as an investor, I have always liked that category when I am not sure what I want to do next. If I have 3 years money, which is conservative, I would obviously go to a fixed income fund. If I have made up my mind on what portion of equities I want to run in my personal portfolio, I would go and invest there. When I'm in that in-between phase where, I'm assessing, what to do next, I have found that to be a very good vehicle. When you have less than 3-year money, but you want to optimize your tax adjusted returns. So I myself have found that product to add quite a bit of value in my portfolio.
Right.
First portfolio as a consumer.
Right. I mean, like I said in one of my talks, it's the uncertain part of the uncertain money of the portfolio, which sits in arbitrage funds.
That's very well put.
Funds, but below 3 years, obviously after 3 years, debt funds get an tax advantage and are much superior and tax efficient. Suyash, coming to another asset class, which we've spoken about in the past, and it is now again gaining popularity, is gold. How do you view gold as an asset class over the next few years?
Actually, I don't have a concrete view on this, simply because I have, at least from a macroeconomic standpoint, gold can be argued upon in a variety of ways. So it's a hedge against inflation. It's a hedge in an uncertain market. It is a hedge against currency devaluations.
Right.
If I were to just, peg my hat on something here, I would think, especially in the kind of uncertain world we are in, it should probably be part of a portfolio because there are risks in the system which probably can be efficiently mitigated here. The obvious downside is that you earn next to no carry. That's how I would look at it. In a very uncertain financial system, with the kind of global debt that is being taken on, probably, as a diversification tool, it would be a good tool.
Right.
I don't have a very concrete view on it.
Right. A follow-up question on this. I mean, personally, what kind of asset allocation would you advocate? I mean, I know it's different for different people depending on what asset classes they're comfortable with, but generally, what kind of asset allocation do you carry at the moment, or what do you advocate to investors in terms of equities, fixed income, gold? I'm leaving property out of it because property is really...
Right. So I would be at this point roughly 50-50 between fixed income and equities. I used to be much lower on equities, but I am not now. But my philosophy there is largely anchored around, and I speak as a layman now. My philosophy there is anchored around the fact that risk-free rates around the world have collapsed, and therefore, I don't think we are a generation of people who will be in a position to create very high income or wealth from our savings. I think that is past us. The format of the world has moved on. The focus on efficient allocation of capital is no longer the theme. It is really a very low level of risk-free rate against which everything else looks good, which fundamentally is not a grounds-up capitalistic model. It is more, a top-down forcible reallocation of profits from efficiency to everybody. So what I'm basically saying is, and I could be entirely wrong on this thesis, that that period of you know massive compounding of savings is probably behind us, because I don't see from a macro standpoint that that is the framework of the world. And therefore, one has to be quite strong on one's risk management, and to a very large extent, probably not fall into the trap of continuing to draw upon that golden era of 2002 to 2008. I see a lot of investment theses that are still anchored around those. I do think that if you look at debt levels in the world, if you look at the state of global trade, the level of suspicion, the volatility in politics, but most fundamentally, this focus away from efficient capital utilization wins and everything else fails, which is how efficiently allocated capital earns supernormal profits. That seems to have been diluted. So just from a philosophy standpoint and looking at the world, my own view, which could be completely wrong, because the question you asked is slightly away from my immediate asset allocation, my asset rather, is that one gets reasonable income, one is through. One should not look for very large compoundings of one's savings. Still, the format of the world changes again.
Right, right. Just a follow-up question on that. In terms of the banking system risk, you did mention that we entered this crisis with a weak banking system and financial system. Do you see, risks escalating in the next few months, or you feel that, we've seen the worst?
So, if you just look at some of our recent history, so India unfortunately has had two back-to-back boom bust cycle in the financial system. So the first, which largely pertained to banks, was the old economy infrastructure asset boom bust, which I think by 2012-13 had kind of run its course, and the residual damage of that was being picked up. And just as that collapsed, we started this NBFC HFC lending cycle, which again became very aggressive over 2013-2018, and that unfortunately busted in with the IL&FS crash in 2018. So there are actually quite a few pieces that one has to pick up. And remember, even in the second cycle, there were linkages, because banks were also lending to NBFCs and they also had their own books, etc. And through this second phase, actually consumer incomes were not rising. So it's not as if the credit profile of consumer was getting better. In fact, almost by definition, because the consumer was taking on so much loan to consume, and which is what the model of growth was, because their incomes were more muted. So as we stand, unless you get a fresh income injection into the system, frankly, from a credit worthiness, lenders may find it a bit of a challenge for the near term, for the next 1.5 years. And second, when books were already relatively weak, to extrapolate this bigger growth shock, which is 5, 6, 7 percentage point of nominal growth shock, you are bound to have NP accretions. Now, today you cannot hypothesize how much this is, because you are in a bit of a black box. So there is moratoriums that are underway. You don't know what the state of those books are going to be once the moratorium is over. So we are at least internally thinking that, the next 1.5 years are going to be challenging. One of the aspects of this system, which we have talked about before also, is that you are in a bit of a data vacuum. So if you see the range of forecasts, both with respect of NP accretion, or for that matter, just the current quarter's GDP for India, which ranges from -10 to -45% is the range of forecast, you would readily know that we are in a very large data vacuum, and therefore you have to be very clear about what objective you are trying to satisfy, because it's quite likely that you may end up overpaying for satisfying that objective. To put it simply, it is possible that a diluted portfolio also survives, in which case you could have earned that 100-150 basis point extra. Possible it does not if this gets much worse, because there is very little data to hypothesize this on. But as long as you are clear that the objective you're trying to satisfy in fixed income is safety and not greed, then even though you have overpaid 100 basis point for satisfying the objective, at least the objective got satisfied. Because remember what could happen otherwise, that you were unclear about your objective. You said that, oh, 6 is better than 5 or 7 is better than 6. And then you ended up trapping yourself in a fresh problem.
Right, right. Interesting. I think it's been a fascinating conversation, Suyash, on macroeconomics, on your philosophy of investing in fixed income and how the funds are managed at IDFC. How do you unwind when you're not managing fixed income money?
You take me to the more boring parts of my personality. Not that the previous ones were very much more interesting, but so one, I can't read non-fiction. I have to read fiction. So I'm very disappointed with myself, almost embarrassed to say that there's hardly a non-fiction book that I would have completed cover to cover, including the greats of the world. So I'm almost compulsive that way. Barring which, it's largely just family and a bit of TV, nothing much.
At Motilal Oswal, we lay a lot of emphasis on knowledge. So I know you did mention that you read more fiction. Any two books that stand out for you or you would like to recommend?
So let me first kind of defend my view on why fiction only is that, see, what I have discovered over a period of time is that perspective is something you have to get for yourself. So nobody can teach you perspective. You can get help. It's data and analysis that you can accumulate, right? So you can get data, you can get analysis of data, but ultimately what to do with that analysis in some form or fashion is probably, that unquantifiable value add that a money manager brings, right? And one could go through a lot of people's perspectives, and obviously it may help to enhance your own perspective. But you can't blindly borrow somebody else's, because no matter how hard I try to communicate a perspective, there would be a nuance there, which is only in my mind and I have not been able to communicate to you. And therefore, if somebody were to go and replicate that, it may have different outcomes. So as long as I have data and analysis, which during our day, we read tons of reports and we do a lot of data analysis for perspective, basically one has to ultimately rely on one's own thinking. From what books, one book that has stayed with me through my last 15-20 years is Lord of the Rings by J.R.R. Tolkien. I thought it's a wonderful, imaginative masterpiece.
Yeah, it's a fascinating book. And I thought even the movie was made very well.
Yes, but otherwise I read almost anything at all. A lot of Stephen King, a lot of other things.
Right, right. Great. Thanks, Suyash. That was really an interesting and insightful conversation. I hope viewers have benefited from our conversation, because there's lots which has happened in the fixed income space around the world and in India. We've had a loss of confidence as well on account of certain credit issues that have happened. But you put it extremely well that mutual funds are ultimately pass-through vehicles. And like you said, at IDFC, liquidity is of paramount importance. And then you did take us through the entire framework as to how a fixed income investor should approach building a portfolio, which is the core portfolio, which should be very, very simple products where you collect yield, and the satellite portion where you can try and add a little extra zinc to the portfolio. But the challenge is, if that satellite portfolio starts becoming a core part of your portfolio, then you run into a lot of issues. And you did mention that one still has to be watchful on core portfolios, because sometimes risks do tend to seep in, and one should be watchful. And hopefully people make use of an advisor to understand the risks better and allocate money in fixed income. So thanks a lot, Suyash. Thank you very much for this conversation. And for everybody out there, thank you for staying tuned. And if you wish to watch this talk again, subscribe to our YouTube channel. If you want to know more about our 4C Fund Manager approach, please write in to us and we'll be more than happy to send you a brief of that process and how we look at fund managers. So thank you very much, Suyash.
Thank you, Ashish. It was an absolute pleasure.